Hello, everyone, and welcome back to another edition of Stateside Weekly Market Report with Bryant Naylor and Tim Robinson. I'm Tim. Hey, Bryant.
How's it going, Tim?
Good, man.
Got
Good.
some cool
We're
lights
just
on back there.
I'm working on it with the lights, man. It's a learning process. It's progress, not perfection. So we're trying to get the lights down, and today we're going to go into our series of contingencies again. We talked last week about how hard it is to get things accepted, our offers accepted in this market with the competition and the lack of inventory, things we've gone on about ad nauseum. One time we talked about inspection contingencies and how we can kind of help clients navigate that to make our offers more attractive to sellers. Today, I think we should talk about dual contingencies that kind of tie in together. One being the financing contingency, and one being the appraisal contingency. And if we have time, we can even talk about gap coverage, appraisal gap coverage, if we wanted to do that. So let's get into that a little bit. Do you want to start with financing? Let's start with the financing contingency. What is a financing contingency, Bryant?
Financing contingency. It's just a clause in the contract that allows the buyer to get out of a home purchase without penalty if they're unable to receive financing from a bank. So, for example, if you buy a house, you get under contract for a house, and you have a financing contingency in place, and you are unable to the bank decides, hey, you don't, your loan to value, your ratios aren't right. We're not going to be able to approve you for this much money. You can get out of the contract and get your earnest money deposit back.
Right. That's
That
it.
is
Yeah.
that's the
That's it.
basics. That's it,
That's
Tim.
it.
I think that
That's
wraps
it.
up financing contingencies.
Thanks for
Uh,
tuning in, everyone. No,
yeah.
I mean, that's
So,
it. It's simple in practice, a little bit more complicated, or simple in principle, a little bit more
all right.
complicated in practice. I mean, the details of it, and we don't need to get too granular, is typically we put in a 21-day financing contingency in there, sometimes 17 or 18 if we're trying to close in 3 weeks with a couple of our lenders that can do that quickly. But it's the final backstop to get out. So if for whatever reason, it's not necessarily your DTI, your debt to income ratio is off, but it's something that gets flagged by underwriting, whether it's a large purchase I don't know, ill-advised made during the contract to close process. You bought a new car and underwriting's like, what is this? You're funneling money and there's a scam going on here, and they flag it. If for
Mhm.
whatever reason your bank cannot lend, you can get out without penalty.
Yep.
In
And what?
conjunction with that, what's
Yeah.
that?
Well, go ahead. What were you going to say? We're going to go into the.
I was going to conjunct appraisal contingencies with financing contingencies.
All right, let's go. What is an appraisal contingency, Tim?
Brian, I'm so glad you asked. Let's tell the people. An appraisal contingency is, and if you've ever listened to my podcast or any content I've ever produced, you realize, and I'm not trying to make the whole appraisal community mad, I'm not a big fan of the appraisal system we have in America.
I hate it.
I think it's very antiquated. I think that there's no reason for one individual to have an opinion of a value of a property, and everyone involved in the transaction has to adhere to that. But this is the game we're playing. These are the rules before us. Whatever your lender sends out an appraiser to get an appraised value so that they know they are going to be provided with collateral to ensure the payback of that loan. They are only going to lend on what this appraiser, this person that they send out, says that house is worth. Period. That's it. So if you're under contract for a house that's $800,000, you offered $800,000. The lender sends out an appraiser. He comes back and says this is only worth 750. The bank says, okay, now we're only going to give you $750,000. In that case, you are on the hook if you do not have an appraisal contingency for that delta, the $50,000 from 750 to 800 in cash that you have to bring to closing. This
Right.
is very, very common in this market the past couple of years. It's been
Very,
perfectly
very common.
normal
Yep.
to bring money to closing because appraisals are coming in low and people are paying over asking. But if you have an appraisal contingency in there, which again makes your offer weaker, it's more exit ramps for us as the buyer, less exit ramps for the seller. We want to provide as many as possible. But if you have an appraisal contingency in there and you get back a low appraisal, you can actually walk away without penalty. So they kind of work in conjunction because they're both based upon the lender, right? If you can't get the appraisal, then you can't get financing, and therefore we can walk away without penalty. As the stronger offer we want to make has neither of those in there because
Nope.
again, it's less exit ramps for us to take and more strong for the listing agent and the seller. Um, so it's a conversation. It's individual, right? It's based on the cyclical nature of the market. It's based on what's available. It's based on your strategy, and it's based on your comfort level with your lender. This is why we use lenders over and over and over again. We have just a couple that we recommend unequivocally, because we know they can close when they say they're going to close, and they will jump through hoops to get it done. If you're working with a lender that you found on Rocket Mortgage or Quicken Loans or some online provider, I would not have any confidence in waiving the financing contingency. We do waive financing contingencies with lenders we work with all the time because we know them. We know they will close. We are not worried about the financing coming through. Appraisal is another strategic barrier, though, because we have no control over that. That's one individual's opinion of the value of a home, and it's very, very important. So, appraisal is something that you kind of have to navigate.
Yeah, I'd say financing is something that when I talk to my clients about it, I tell them what we're going to do is we're going to call your lender and we're just going to talk it out, right? Say on, how are they purchasing at the top of their budget, and is there a chance that for whatever reason they're not going to get approved for this much? And if it's a lender, like I said, that we know and we have a relationship with, we can call them up and be like, listen, we're going to waive the financing contingency. What are your thoughts on doing that? Is it,
Right.
how big of a risk is it? And if they're like, no, these people are solid, there's no way they're not going to get approved for that loan amount, they're approved for four or $500,000 more than that, then I'll pass it on to the clients. Like, listen, this isn't much of a risk at all. You're going to be approved. On the other hand, if it's the appraisal, that's a little different, right? That's in a different conversation, because in this market, a lot of times people are paying over asking for their house.
Right.
So if for whatever reason that the house doesn't appraise for what they're purchasing at, they have to come to the closing table with that cash in hand. And sometimes people don't have that, right? So that's some kind of
No.
a strategy
Yeah.
we got to work out. Like, are you going to put less down on your mortgage, on your loan, and come to the closing table with more cash? Or do we need to kind of go with a different strategy or what? So yeah, but like you said, Tim, there are two things that in this market right now, there are two of the three contingencies, that the primary contingencies that I'm waiving almost automatically with my clients.
Yeah.
Uh,
Yeah, and I mean, it's unfortunate. Call it a seller's market if you want. We're kind of in a mid-market where no one knows what's going on, but the scarcity is real, the competition is real, and like these are things that we need to do if you want to get a house in certain circumstances. It's not across the board. It's not the same in Maryland right now as it is in Northern Virginia. We can still go in with inspection sometimes, financing, yeah, usually, appraisal, yeah, usually. But last year we couldn't. We could not go in with financing contingencies and appraisal contingencies because they would just not be considered. Um, but I mean, the gist of this story is knowledge, just so people know what they're doing. So, like, this isn't a conversation where it's out of the blue and they don't understand. And just these are the things we do for our clients, is kind of help them navigate how to make the strongest offer possible with as many exit ramps as possible if things go awry. And it's an art. It really, like, it
it
is, it
really
is
is.
not straightforward. It is not easy to find out what's going to be attractive for the seller and at the same time protect your best interests, but we do it, and these are the conversations that you need to have. That was my alarm. That was not supposed to go that loud. We're trying to cut these off at 8 minutes because that's the magical number that YouTube says you're supposed to go. Full transparency here. We talk too
We
much,
can't
we
talk
know
anymore.
that, it's
We got to be
okay.
done.
Yeah, it's just, I mean, that is what it is, but 8 minutes is the algorithm. So that that insanely loud alarm that made me think it was 5 in the morning says time's up, folks. Thanks for tuning in for another episode of Stateside Market Report with Bryant Naylor and Tim Robinson. We're getting there, guys. We're getting there. We hope this is valuable. We make jokes, and that's fine. That's just what we do.
Yeah.
Give us a call. Happy to help. Until
Thanks,
next week.
everybody. Yep. Have a good day.